Hi everyone, I'm Ben Squires, the Chief Investment Officer at NGS Super, and today I'd like to share our latest views on the market by answering three key questions. 1. Why are share markets performing strongly in the face of slowing economic growth? 2. How is the economy staying resilient in the face of historical high interest rates? And 3. How is NGS Super positioning the portfolio to navigate the current economic conditions? The three drivers of strong share markets despite slowing economic conditions are: businesses on average continue to beat market expectations on earnings, leading to more positive rather than negative earning announcements. Inflation is trending lower across both goods and services, and the market anticipates that central banks around the world are finished with interest rate increases. The impact of higher interest rates are yet to have a material impact on economic growth, which is good news. And thirdly, recession indicators are stable to reducing, particularly in the US, and this again is providing support for company profitability. The International Monetary Fund recently projected a soft landing for the world economy with an updated growth outlook of 3.1% for 2024. The NGS portfolio has benefited from these strong conditions. The diversified MySuper option returned an improved performance for the financial year to date as of the 7th of February of 4.62%. Over that same period, the international shares option returned 9.6% and the Australian shares option returned 7.28%. Within the share market, technology companies such as Nvidia, Microsoft, Alphabet, Amazon, Apple, Tesla and Meta led the market higher as sentiment continues to be positive about the benefits to be gained from generative artificial intelligence, which technology companies, as mentioned, have an interest in. While the global economy news to date has been positive, there are risks on the horizon. Geopolitical tensions are increasing, the pending US election later on this year, and tighter financial conditions which are yet to be fully reflected across the whole economy. Closer to home, Australian households have so far been able to absorb rising interest rates, but they have tightened their belts when it comes to discretionary spending. The recently announced Stage 3 tax cuts will help household incomes, and with the prospects of interest rate cuts in 2024, there is reason to be optimistic on the Australian economy. Persistent shortages in the residential housing sector are likely to prevent any major correction from occurring. However, in office towers, they struggle under low occupancy rates as people continue to have a work from home preference. Over the next 6 months, we see recession risk remaining low. We'll be maintaining our allocation to the share market with a constant reference to the 4 key defensive levers in our portfolio, which include government bonds, precious metals such as gold, US dollar and Japanese yen. We use these instruments to protect the portfolio against deteriorating economic conditions. I look forward to providing further economic updates as economic conditions change into the future.